Welcome to the chapter on behavioral finance. This field combines psychology and economics to explain why and how investors make decisions that deviate from traditional financial theories. In this chapter, we will explore behavioral biases, market anomalies, and behavioral corporate finance. These topics will help you understand the psychological factors influencing investor behavior and market outcomes. Behavioral biases are systematic patterns where judgments deviate from rationality. These biases can lead to illogical inferences about people and situations. Overconfidence bias occurs when investors overestimate their knowledge and abilities. This can lead to excessive trading and risk-taking. For example, an investor who believes they can consistently pick winning stocks without considering the possibility of error may trade more frequently, incurring higher transaction costs and potentially lower returns. Anchoring bias happens when individuals rely too heavily on an initial piece of information known as the anchor when making decisions. This can affect how they assess new information. For instance, if an investor buys a stock at $50 and it drops to $30, they might hold on to it, anchored to the initial purchase price, hoping it will return to $50 rather than objectively assessing its current value and future prospects. Herd behavior is the tendency for individuals to mimic the actions of a larger group, regardless of their own beliefs or the underlying fundamentals. For example, during a market bubble, investors might buy stocks simply because others are doing so, driving prices higher without regard to the actual value of the stocks. Market anomalies are price patterns or behaviors in financial markets that seem to contradict the efficient market hypothesis. Examples include the January effect, the momentum effect, and the value effect. The January effect is the tendency for stock prices, particularly small-cap stocks, to rise in January more than in other months. This anomaly is often attributed to tax loss selling in December and the reinvestment of funds in January. For example, investors might sell losing stocks in December to realize tax losses and then repurchase them in January, driving up prices. The momentum effect refers to the tendency for stocks that have performed well in the past to continue performing well in the near future, and vice versa for poorly performing stocks. For instance, if a stock has been rising steadily for several months, momentum investors might buy it, expecting the trend to continue. The value effect is the tendency for stocks with low price-to-earnings ratios or high book-to-market ratios to outperform stocks with high price-to-earnings ratios or low book-to-market ratios. For example, investors might buy undervalued stocks, expecting that the market will eventually recognize their true value, leading to higher returns. Behavioral corporate finance examines how psychological factors and biases affect the financial decisions of managers and corporations. Key concepts include managerial overconfidence, herding in corporate decisions, and behavioral signaling. Managers who are overconfident may overestimate their ability to generate returns from investments, leading to overinvestment or poor acquisition decisions. For example, a CEO might pursue an aggressive expansion strategy, believing they can outperform competitors, even when market conditions suggest caution. Just as individual investors can exhibit herd behavior, corporate managers may also follow industry trends or the actions of competitors, sometimes to the detriment of their own company's interests. For instance, if one company in an industry starts a share buyback program, others might follow suit, even if their financial situation doesn't justify it. Managers might use financial decisions to signal confidence to the market, even if those decisions are not in the best interest of the company. For example, a company might increase dividends to signal financial strength, even if it means taking on debt or cutting back on essential investments. Behavioral finance provides valuable insights into the psychological factors that influence investor behavior and market outcomes. By understanding behavioral biases, market anomalies, and the impact of psychology on corporate finance, students can better appreciate the complexities of financial decision-making and the limitations of traditional financial theories.